In an era marked by globalization and intricate financial systems, the issue of tax evasion and hidden economic activities poses a significant challenge to governments worldwide. Unreported income and untaxed transactions contribute to what is known as the shadow economy, a hidden realm that operates outside the purview of official statistics and regulatory frameworks. This clandestine network of economic activities undermines fair competition, deprives governments of much-needed revenue, and erodes public trust in institutions. Indonesia, a dynamic archipelago nation with a rapidly developing economy, faces its own unique set of challenges in combating tax evasion. The country's complex business environment, coupled with a substantial informal sector, creates opportunities for individuals and corporations to conceal income and evade their tax obligations. Recognizing the urgent need for innovative solutions, Indonesian economist Dr. Joko Ismuhadi developed a groundbreaking tool known as Ismuhadi's Equation, or TAI. This equation represents a paradigm shift in tax compliance and economic transparency. By harnessing the power of financial data analysis, Ismuhadi's equation enables tax authorities to identify discrepancies that serve as red flags for potential tax evasion. The equation's ability to detect hidden economic activities has earned it recognition as a game changer in the field of tax enforcement. This essay will delve into the intricacies of Ismuhadi's equation, exploring its origins in traditional accounting principles and its adaptation to the Indonesian context. We will examine how the equation works, its practical applications, and its limitations. Through real-world examples, we will illustrate the equation's effectiveness in identifying tax evasion and fostering a more transparent and accountable economic landscape in Indonesia. To fully grasp the significance of Ismuhadi's equation, it is essential to first understand the fundamental principles of accounting upon which it builds. At its core, accounting revolves around the fundamental accounting equation, a cornerstone of financial reporting that provides a snapshot of an entity's financial position at a specific point in time. The traditional accounting equation can be represented as assets equals liabilities plus equity. This equation states that an entity's assets, which represent its economic resources, are financed by a combination of its liabilities, which are its obligations to others, and equity, which represents the residual interest in the assets after deducting liabilities. This fundamental equation forms the basis for double-entry bookkeeping, a system in which every financial transaction is recorded twice, once as a debit and once as a credit, to ensure that the accounting equation always remains balanced. Assets encompass all things of value that an entity owns or controls, including tangible items like cash, inventory and property, plant and equipment, as well as intangible assets like patents, copyrights and goodwill. Liabilities, on the other hand, represent an entity's obligations to pay money or provide goods or services to others in the future. These obligations can arise from a variety of sources, such as borrowing money, purchasing goods or services on credit, or incurring taxes payable. Equity, the final component of the accounting equation, represents the residual interest in the assets of an entity after deducting its liabilities. It reflects the ownership stake in the entity and is typically comprised of contributions from owners, retained earnings, and other comprehensive income. Understanding the traditional accounting equation is crucial because Ismuhadi's equation adapts and reconfigures this fundamental principle to create a powerful tool for detecting tax evasion. By focusing on the relationship between revenue and liabilities, Ismuhadi's equation leverages the interconnectedness of financial data to unveil discrepancies that may indicate hidden economic activity. Building upon the foundation of traditional accounting principles, Dr. Joko Ismuhadi developed his groundbreaking equation as a means to address a pressing issue facing Indonesia: tax evasion. Recognizing the limitations of conventional accounting methods in uncovering hidden economic activities, Ismuhadi sought to create a tool that could pierce the veil of financial secrecy and expose discrepancies that could indicate tax avoidance. Ismuhadi's equation, often referred to as the tax accounting equation, shifts the focus from the static representation of assets, liabilities, and equity to a more dynamic analysis of revenue and liabilities. The equation posits that an increase in revenue should, under normal circumstances, lead to a corresponding decrease in liabilities. This logical correlation stems from the fact that businesses typically use a portion of their earnings to settle their financial obligations, such as paying down debts, taxes, or supplier invoices. The TIE can be conceptually represented as follows: revenues equal expenses plus assets minus liabilities. This reconfiguration of the traditional accounting equation highlights the interconnectedness of these financial elements. By analyzing the relationship between revenue and liabilities, Ismuhadi's equation can identify instances where reported liabilities appear unusually high compared to reported revenue growth. Such discrepancies serve as red flags, signaling the potential for underreported income and tax avoidance. The rationale behind this approach is rooted in the behavior of tax evaders. To minimize their tax liability, individuals or businesses may employ various tactics to conceal their true income. One common method involves inflating liabilities. By overstating expenses or creating fictitious debts, tax evaders can effectively reduce their reported taxable income, thus lowering their tax burden. Ismuhadi's equation provides a framework for identifying these suspicious financial patterns. By analyzing financial statements and comparing reported figures against expected values, tax authorities can pinpoint instances where liabilities appear disproportionately high in relation to revenue growth. This targeted approach enables more efficient allocation of resources, focusing investigative efforts on entities that exhibit a higher likelihood of tax evasion. Ismuhadi's equation isn't just a mathematical curiosity. It's, a powerful tool designed to navigate the intricate and often unpredictable terrain of complex systems. Imagine for a moment trying to predict the weather or the stock market or even the spread of a new virus. These are systems where countless variables interact in ways that are, quite frankly, mind-boggling. But Ismuhadi's equation provides a way to cut through the chaos. It helps us identify patterns and, more importantly, make informed predictions. This equation has been a game-changer for researchers and professionals across various fields. From climate scientists to financial analysts and even epidemiologists, it's become an indispensable part of their toolkit. So, while it may seem abstract at first glance, the real-world applications of Ismuhadi's equation are nothing short of revolutionary. It's a testament to the power of mathematics to, make sense of our complex world. Ismuhadi's equation isn't just a theoretical construct. It has practical applications that can be observed in real-world scenarios. By analyzing data through this lens, policymakers can identify patterns of tax evasion and take corrective measures. This approach not only helps in recovering lost revenue, but also in creating a more fair and just economic system. Strengthening tax enforcement is crucial for any economy. With the insights provided by Ismuhadi's equation, authorities can develop more effective strategies to combat tax evasion. By doing so, they ensure that everyone pays their fair share, which ultimately benefits society as a whole. Tax evasion tactics are constantly evolving. As new loopholes and methods are discovered, it's essential for enforcement techniques to adapt as well. Ismuhadi's equation offers a dynamic tool that can keep up with these changes, providing a robust framework for ongoing vigilance and adaptation. The ultimate goal is to move towards a more transparent and equitable economy. By leveraging the power of Ismuhadi's equation, we can create a system where tax obligations are clear and compliance is the norm. This not only fosters trust in the economic system, but also promotes a sense of fairness and responsibility among all participants.